Most people thought they were watching another conflict in the Middle East. They were not. They were watching a test of whether the world still needs the dollar the way it used to. And when money gets tested at the same place where oil gets trapped, the story stops being regional. It becomes personal, even if you live thousands of miles away and have never seen an oil tanker in your life. If you like the kind of breakdown that spots the crack before the wall starts moving, stay close to this channel, because this story is not really about one country. It is about the hidden machine under prices, savings, debt, and power. And once you see that machine, a lot of headlines that used to feel random start fitting together. That is where this gets uncomfortable, because what happened was not just a fight over territory or revenge or military pressure. It was a challenge to a habit the world has lived with for decades, a habit so normal that most people never even ask where it came from. They just assume oil is bought in dollars because that is the way things are. But the way things are is often just a deal that lasted long enough to feel natural. And when that deal starts to wobble, the first sign is rarely a dramatic speech. It shows up in plumbing, in shipping routes, in settlement systems, insurance costs, banking rails, and the quiet choices countries make when they no longer feel safe depending on one gatekeeper. That is why this matters to someone with a paycheck, a mortgage, a retirement account, or cash in the bank. If the world needs fewer dollars to move energy, then the special support holding up the dollar becomes a little weaker, not gone in a day, not shattered in 1 week, just weaker, which is often how the biggest changes begin. Think of the global economy like a giant stadium. If every food stand inside that stadium accepts only one kind of token, then everyone entering has to get those tokens first. They may not love the token. They may not trust the company that made it, but if they want to eat, they need the token. For decades, oil worked a lot like that. Not perfectly, not completely, but close enough that nations built their reserve piles around the dollar. If you needed energy, you needed access to the currency that bought energy. That constant need created a deep automatic demand, and that automatic demand gave the United States an advantage most countries could only dream about. That advantage became even more important after the early 1970s, when the dollar was no longer tied to gold the old way. Once money is not linked to a hard asset, faith matters more, demand matters more. The question becomes simple and brutal. Why should the rest of the world keep holding your paper, your bonds, your promises? America's answer was not just economic strength, it was a system. That system came together around oil and security. Major producers sold energy in dollars. The revenue they earned did not just sit still. A large share flowed back into American debt markets, banks, and financial assets. So the loop kept feeding itself. The world needed dollars for energy, and those dollars kept coming back to support the same system that issued them. When you understand that loop, you understand why the dollar has enjoyed room that other countries do not get. America could borrow more easily, run larger deficits for longer, project financial pressure through sanctions, absorb mistakes that would have crushed weaker currencies. The dollar was not powerful only because of trust. It was powerful because the world kept needing it for something essential. Now picture what happens when a choke point suddenly starts acting like a toll booth with a new rule. The Strait of Hormuz is not just a line on a map. It is one of the narrow passages through which a huge amount of the world's oil supply moves. So when Iran signaled that cargo passing through that route would need to settle in Chinese yuan instead of dollars, the message was bigger than the headline. It was, the ticket accepted at the gate may be changing. And if you are the kind of viewer who wants to catch that kind of shift before the crowd turns it into panic, this channel belongs in your regular rotation, because the loud story was missiles and ships. The quiet story was currency leverage. And quiet stories are often the ones that stay alive long after the explosions leave the screen. What made this different was not just the currency involved. Countries have talked for years about using something other than the dollar. There have been summits, speeches, press releases, and endless talk about alternatives. Most of that produced more noise than change. This was different because it touched real trade at a real choke point under real pressure. That matters. A theoretical alternative is one thing. A tanker captain, an insurer, a buyer, and a government all adapting in real time is something else. Once a mechanism works in the real world, even under stress, people remember it. And once they remember it, they start asking a dangerous question. If we can do this once, what stops us from doing it again? That question spreads fast. Energy importers start thinking about supply risk differently. Central banks start thinking about reserves differently. Governments that once felt comfortable parking huge wealth in dollar systems begin wondering how safe that comfort really is. Not because they all love China, not because they all hate America, because dependence feels fine until it starts to look like vulnerability. This is also why the reaction of the Gulf states matters so much. For years, many people treated the old oil dollar arrangement like a law of nature. It was never that. It was an alignment of interests, security on one side, pricing and recycling on the other. If the countries at the heart of that arrangement stop feeling protected, the emotional glue holding the system together gets weaker. And this is where the story stops being about enemies and starts being about partners. When traditional U.S.-aligned states quietly review contracts, future investments, payment setups, and strategic exposure, that is not a symbolic gesture. That is a signal. It means the people who benefited from the old design are no longer assuming the old design will hold forever. And when insiders start building exits, outsiders pay attention. China understood something important years ago. You cannot challenge a dominant currency with speeches alone. You need rails. You need payment systems, swap lines, settlement channels, and cross-border tools that allow trade to happen without passing through the old center every single time. In simple terms, you need new roads, not just complaints about traffic. And those roads have been getting built quietly. Now, a lot of people hear that and jump straight to a dramatic conclusion. They imagine the dollar suddenly collapsing as if the entire world wakes up one morning and flips a switch. That is not how reserve systems usually change. People do not abandon the old leader overnight. They reduce exposure, they build backups, they add options. The process starts looking boring right up until it stops being boring. So no, the yuan is not about to take the dollar's crown tomorrow morning. China still has barriers, controls, and trust issues that limit how far its currency can travel. Global investors still value the depth and openness of American markets. The dollar remains deeply embedded in trade, debt, finance, and habit. But the key word there is embedded, not untouchable. If you find this kind of slow motion power shift more useful than clickbait panic, make sure this channel stays on your radar, because the world rarely changes with one giant bang. It changes through small adjustments that stack up, and by the time most people notice the pattern, the smart money has already been living inside it for a while. A cleaner way to understand this is to stop thinking in terms of collapse and start thinking in terms of phases. Phase one is doubt. Something happens that makes countries question whether the old system is as safe or as neutral as they assumed. That doubt may be triggered by sanctions, war, frozen assets, blocked trade, or sudden policy weaponization. Once doubt appears, the story has already changed. Phase two is workaround. This is when countries do not leave the system, but they start testing side doors. They settle a portion of trade in another currency. They open a swap line, they buy more gold, they join a payment platform that lets them clear transactions without routing everything through the same old channels. Each move looks small by itself. Together, they reduce dependence. Phase three is habit change. This is the phase most people miss because it looks too ordinary to be historic. A few deals become many deals. A backup becomes routine. Treasurers, importers, and central banks stop treating the alternative as an experiment and start treating it as part of normal operations. Once that happens, the old system loses something precious, not control, but inevitability. And that last part is huge. Reserve currencies do not live on economics alone. They live on belief, on repetition, on the sense that everybody else will keep using them, so you should too. The moment that sense weakens, even a little, the system becomes more expensive to maintain. It still works, but it no longer works effortlessly. And effortless power is the kind power likes most. Now let's walk through the two paths from here, because this is where people usually get trapped in extremes. Path one is the easier one to imagine. The fighting cools down. Shipping gradually normalizes. The emergency demand for alternate settlement methods fades. Oil flows more smoothly again, and the dollar keeps its central role. A lot of people will then say, see, nothing changed. But that would be the wrong reading, because even in that softer outcome, the world learned something. It learned that a critical energy passage can become a currency pressure point. It learned that non-dollar settlement is not just theory. It learned that trusted partners can feel exposed. And once that lesson enters the strategic mind of nations, it does not disappear just because the immediate crisis fades from television. In that first path, the old order survives, but it comes out with a scar. Central banks that were already diversifying do it faster. Energy buyers build more than one payment option. Countries that once held dollar reserves without much thought begin asking how much is prudent and how much is just habit. The dollar stays first, but first place becomes more contested. That matters, even without drama. Path two is the harder path. The conflict drags on, the choke point remains unstable, more energy trade across Asia becomes comfortable using non-dollar settlement when necessary. Insurance, routing, political risk, and payment risk all start pushing in the same direction. At that point, the shift stops being a hedge and starts becoming a pattern. And patterns are what reprice the world. If that second path grows, the pressure does not land only in foreign ministries and central banks. It lands in bond markets. The United States carries an enormous debt load, and debt is easier to carry when the world has a strong built-in reason to keep buying your paper. If that reason weakens even gradually, borrowing costs can rise. And when borrowing costs rise in a heavily indebted system, pain travels fast. If you want one question to keep following with me on this channel, let it be this. What happens when the world still trusts the dollar but no longer needs quite as much of it? That is the real puzzle. Not total rejection, not instant replacement, just less automatic demand. And in financial systems, a little less automatic can turn into a lot more fragile sooner than people expect. Now bring that back down to normal life. Higher borrowing costs at the sovereign level do not stay in a glass box in Washington. They leak outward. They affect mortgages, corporate debt, credit conditions, investment appetite, housing, hiring, and public spending. If the government must pay more to finance itself, the whole system starts feeling tighter. Somewhere, somebody pays for that. Usually, it is not the people closest to the printing press. This is also why inflation fears do not disappear just because one headline calms down. When energy routes are unstable, transport costs move. When currencies shift, import pricing gets messy. When governments face more pressure financing debt, policy choices get uglier. That does not guarantee runaway inflation tomorrow, but it does mean the cushion people got used to may be thinner than they think. And thin cushions matter when economies stumble. That brings us to a quiet behavior worth watching. What central banks have been doing for years. They have been buying gold more aggressively than many casual investors realize. Why? Because gold is not someone else's liability. It is not a promise from another government. It does not depend on a central bank across the ocean deciding you are still welcome inside the system. It just sits there, politically inconvenient and financially stubborn. That does not mean gold is magic. It goes up, it goes down, it gets overhyped, and it can disappoint for long stretches. But in a world where payment systems are becoming more geopolitical, gold regains a kind of relevance that modern finance likes to pretend is outdated. It is monetary insurance, not exciting insurance, not flashy insurance. but the kind that suddenly looks smart when trust gets weaponized. There is another layer too. If key oil routes become riskier, value shifts toward energy assets and infrastructure in more stable regions. Pipelines, terminals, storage, liquefied natural gas capacity, and alternative export corridors all become more important. When one highway looks dangerous, the side roads gain value. That does not just change trade, it changes investment, diplomacy, regional strategy, and who becomes more useful to whom. The mistake most people make is turning this into a cartoon. Either they say the dollar is finished, which is lazy, or they say the dollar is too big to be challenged, which is also lazy. Big systems usually decline in stages, not slogans. They remain dominant while quietly losing exclusivity. They stay strong while becoming less absolute. That middle zone is hard to talk about, which is why so many people skip it, but history lives in that middle zone. The old British order did not vanish in one dramatic afternoon. Its influence faded through debt strain, war costs, shifting trade patterns, and the rise of another financial center with deeper capacity. People living through the transition could still point to reasons the old system mattered. They were right. What they missed was that still matters is not the same thing as will remain unmatched. So what should you watch now if you want to see whether this story keeps growing? Watch how often energy deals settle outside the dollar. Watch whether more countries increase gold reserves. Watch whether payment platforms outside the traditional Western rails keep expanding. Watch whether America's borrowing costs rise at moments when demand should normally stay strong. And watch what U.S. partners do, not just what U.S. rivals say, because partners tell you whether confidence is holding. Rivals always want change. That is not news. The real news is when allies start building flexibility, when they stop acting like there is only one safe lane, when they diversify without making a loud public speech about it. That is how serious players move when they sense the map is changing before the crowd has updated its language. And if these are the kinds of signals you want decoded without the noise, keep this channel close, not for panic, not for prediction theater, for pattern recognition, because the people who do best in turning points are usually not the loudest people in the room. They are the ones who notice the plumbing before everyone else notices the flood. The deepest truth here is almost simple. A reserve currency is not just a unit of account. It is a form of organized trust backed by power, trade, law, and habit. For a long time, the dollar had all four in overwhelming size. It still has more of them than anyone else. But more than anyone else is not the same as safe from erosion. That is the gap the world has started exploring. And that is why the moment at Hormuz matters beyond the headlines that flashed across news screens. It was a glimpse of something many people assumed could not happen in practical terms. A critical artery of global energy became linked, however briefly or partially, to a different settlement logic. That is enough to force new thinking. Once new thinking reaches reserve managers, finance ministers, and energy planners, it enters the bloodstream of the future. The biggest danger for ordinary people is not that they panic too early. It is that they wait for a perfect headline that says in plain words, the old system is ending now. Systems almost never give you that courtesy. They shift through a chain of events that each look manageable on their own. By the time the pattern becomes obvious, prices, portfolios, and policies have already adjusted. The bill arrives after the signal. So no, this is not the end of the dollar, but it may be one of those moments people point back to later and say, that was when the illusion cracked. That was when a lot of countries stopped asking whether alternatives were possible and started asking how quickly they could make them usable. That was when energy, money, and power stopped pretending to be separate stories. And once those three merge, the world does not go back to sleep easily. If the last few minutes gave you a different lens on the world than the one you started with, that is exactly why this channel exists. To help you see the structure behind the shock, to connect the root, the currency, the debt, and the consequence. Because when the next signal hits, and it will, you will want more than headlines. You will want a map. And here is the line I would leave you with. Empires do not lose monetary power the way movies lose sound all at once. They lose it the way stone loses shape, slowly, under pressure, until one day people notice the edges are gone. What happened around oil was not the final collapse of anything. It was the sound of pressure doing its work.